Welcome to Silver&Metal IQ, the channel where we break through the noise and bring you the real story behind gold and silver markets. I'm Peter, and today's discussion is critical because right now, fear is spreading fast across the precious metal space. Rumors are flying, headlines are screaming, and a single question is dominating investor conversations worldwide. Is silver about to crash? Some are even warning that a major sell-off in both silver and gold could be triggered as early as Friday. For many investors, especially newer stackers, that kind of talk can feel unsettling. But before emotions take over, we need to slow this down, zoom out, and separate noise from structure. Because what's happening right now is far more nuanced than a simple crash narrative. Let's start with the price action itself. Silver recently surged close to record all-time highs, reaching into the low 80s before pulling back slightly. That pullback has sparked panic in some corners of the market, but from a technical perspective, what we've seen so far looks far more like normal profit-taking inside a powerful bull trend, not a breakdown. In strong bull markets, corrections are not a sign of weakness, they are a sign of health. They reset momentum, cool off overheated indicators, and create the base for the next leg higher. We saw this exact behavior earlier in the move when silver consolidated around the low 50s. Once that range broke, price accelerated dramatically. History doesn't repeat perfectly, but it often rhymes. Now, here's where things get interesting. The current fear is not coming from technical damage. It's coming from forced selling, and that distinction matters a lot. There are reports circulating about a mandatory rebalancing event tied to major commodity indices. Specifically, certain large institutional players are required to reduce their exposure to assets that have outperformed over the past year. Because silver and gold have risen sharply, these entities may be forced to sell, not because they believe prices are too high, but because rules demand it. This is not discretionary selling, it's mechanical. And mechanical selling behaves very differently from emotional panic. The estimated numbers sound large, billions of dollars in notional value, and that's what's fueling the fear. But here's the key point most people are missing. This selling primarily affects paper markets, not physical metal. Futures contracts, ETFs, and derivatives may change hands rapidly, but bars and coins don't suddenly flood the market because of an index rebalance. And that distinction is absolutely crucial for stackers. Physical silver operates under an entirely different set of constraints. Supply is tight. Dealer inventories are strained. Delivery delays are increasing. In many cases, when spot prices dip, premiums simply rise to compensate, meaning physical prices don't fall nearly as much as paper charts suggest. This is why experienced stackers don't panic during volatility. They understand that the paper price can move violently while the underlying physical reality remains unchanged. So the real question isn't, will silver dip? The real question is, what happens after the forced selling ends, and whether the market absorbs it quietly or uses it as fuel for the next breakout. We explored why forced selling, not panic, is driving the fear right now. Let's go deeper into the mechanics, because understanding how these moves happen is what separates smart stackers from reactive traders. The core of this story revolves around index rebalancing. Major commodity indices, like the Bloomberg Commodity Index, BCOM, periodically reassess their holdings to ensure they align with target allocations. When assets have appreciated significantly over the past year, they exceed their target weight, forcing the index to sell off portions of its positions. For silver and gold, this could mean billions of dollars in paper selling hitting the market over just a few days. For example, estimates suggest that the BCOM may need to offload roughly $7 billion of silver and a similar amount of gold. On the surface, that sounds like a huge shakeup, and it is. But here's the crucial nuance. This is happening primarily in the paper market, futures, ETFs, and derivatives, not in physical bullion. This distinction is a lifeline for stackers. Physical silver supply remains tight. Dealers like SD Bullion and APMEX are reporting limited availability of popular bars and coins. Presale dates are stretching weeks into the future. So even if paper silver faces downward pressure, the price of real deliverable metal isn't guaranteed to crash. In many cases, premiums on bars and coins may even increase as the market absorbs the paper selling. Now, some traders might panic at the thought of a sudden dip, but let's put this into context. Historical patterns show that short-term drops during forced selling events are often temporary. These dips can actually create excellent entry points for long-term accumulation. Experienced stackers see them as opportunities, not warnings. Additionally, market fundamentals continue to favor silver's long-term bull thesis. Industrial demand, especially for solar panels, electronics, and AI data centers, remains inelastic. Even if global economic growth slows slightly, silver's industrial applications create a baseline of consistent demand. Combine that with geopolitical tensions, rising inflation, and increasing monetary stimulus, and you have a market primed for continued upward pressure over time. Here's another key insight. Forced selling isn't discretionary trading. Unlike normal market swings where traders react emotionally, this is mechanical. These institutions must sell to comply with rules, not because of technical indicators, sentiment, or future outlook. That creates a very predictable, short-lived dynamic that savvy investors can anticipate. So, what does this mean for you as a stacker? It means that even if the price of paper silver dips over the next few days, your physical holdings are largely insulated. The volatility in the futures market can be seen as a temporary distortion. And for those ready to buy, it's a potential opportunity to add to their stack at slightly lower effective prices. If you've been following the chatter online, you've probably heard rumors of a potential crash. But before panic sets in, let's break it all down, from the charts to the market mechanics, so you know exactly what's happening and what it could mean for your stack. First, let's look at silver's recent performance. Yesterday, we nearly touched an all-time high at 82.75 per ounce, followed by a minor pullback today. This is not unusual. Profit-taking is a normal part of any bull run. What's interesting here is the triangle consolidation pattern forming on the daily chart. Historically, these patterns signal that after a period of sideways movement, a breakout, usually to the upside in a strong bull market, is highly likely. Remember when silver hovered around $50 before surging to $83? That breakout created massive momentum, and the current pattern could set the stage for another major move. Now, why are people talking about a potential sell-off? The buzz comes from a BCOM, Bloomberg Commodity Index, rebalancing event. Every year, indices like BCOM must adjust their holdings to maintain target allocations. Because silver and gold have appreciated so sharply, these indices might need to sell billions in derivatives to rebalance. Estimates suggest $7.1 billion in silver and $7 billion in gold could hit the market over a few days, a significant number that could create short-term volatility. But here's the key. This is mostly paper silver, not physical bars or coins. So while futures contracts and ETFs may experience price swings, physical silver demand remains strong, and supply is tight. Look at SD Bullion or other major dealers. Many high-demand products are sold out, with shipping delays extending weeks. This means that even if paper prices dip, the premium on physical silver may rise, protecting stackers from real losses. From a trading perspective, yes, a temporary drop could happen, perhaps a retest of the bottom of the triangle pattern. Could silver fall below $70? It's possible, but unlikely in the context of this bull market. And for stackers, a dip isn't a threat, it's an opportunity. Every correction is a chance to add physical ounces at a better price, which is exactly what seasoned stackers like us look for. Additionally, geopolitical tensions and global economic factors are fueling silver's safe haven appeal. With U.S. debt growing, international conflicts simmering, and the potential for aggressive monetary policy, silver remains a hedge against uncertainty. And industrial demand, from solar panels to AI data centers, continues to support prices even if the broader economy slows. So, the takeaway here is clear. While a short-term paper sell-off might create headlines, the silver bull market remains intact. Stackers should stay calm, watch for buying opportunities, and remember, volatility is your friend when accumulating physical metal. The silver market is showing signs of heightened volatility as we approach the next major rebalancing event. Analysts have been closely watching the Bloomberg Commodity Index, and the signals suggest that forced selling of paper silver could shake the market in the short term. Over the next few days, we might see the equivalent of billions of dollars in notional selling pressure hitting the precious metals complex. While this may trigger a temporary dip in prices, it's critical to understand that this is structural, not discretionary selling. Large institutional holders are not selling based on charts or technicals. They are simply following their mandated rebalancing rules. Physical silver, however, tells a very different story. The tightness in the physical market continues to grow, with online dealers reporting extended pre-sale dates and back orders for popular 100-ounce silver bars. This disparity between paper and physical silver highlights a key opportunity for stackers. Short-term volatility in paper markets does not directly translate to discounts on physical metal. In fact, premiums on physical silver may even rise if paper prices temporarily drop, reflecting the strong underlying demand. Beyond rebalancing pressures, geopolitical developments are increasingly influencing safe haven demand. The recent seizure of a Russian-flagged tanker linked to Venezuela underscores growing instability in global supply chains. Coupled with ongoing tensions between major economies and persistent talk of currency debasement, these events continue to support the case for long-term accumulation of gold and silver. Industrial demand for silver remains resilient, with sectors like solar energy and electronics continuing to consume significant quantities of the metal even amid slowing economic data. From a technical perspective, silver remains in a strong bull trend. Recent corrections have allowed the RSI and other momentum indicators to reset after overbought conditions, setting the stage for a potential breakout to new highs. Historical patterns, such as the long-term cup and handle formation dating back decades, suggest that even sharp dips could be seen as entry points rather than reasons for panic. The gold-to-silver ratio also continues to indicate potential silver outperformance, giving stackers further confidence in strategic accumulation. Finally, monetary policy remains a critical factor. Despite current market expectations of modest rate cuts, the combination of weakening economic indicators and potential fiscal stimulus points toward a much more aggressive easing cycle. If these dynamics play out, silver and gold are likely to benefit significantly from currency debasement, with the current price levels appearing increasingly attractive relative to historic valuations. For stackers, these conditions reinforce the principle of accumulating physical metals during dips rather than attempting to time short-term price swings. Volatility in the silver market continues to capture attention, but the long-term picture remains overwhelmingly bullish. Recent pullbacks should be seen as strategic opportunities rather than warnings. Paper silver may experience forced selling due to rebalancing or speculative pressure, but the physical market continues to show signs of scarcity. Dealers are reporting persistent back orders on popular bullion products, while premiums on physical silver remain elevated. This disconnect between paper and physical markets presents a clear advantage for stackers. Short-term market dips may allow accumulation of real metal at more favorable prices, but you're unlikely to see dramatic discounts on physical silver because demand is still outstripping supply. One of the most compelling factors driving silver's long-term strength is industrial demand. Solar energy, electronics, and emerging AI infrastructure continue to rely heavily on silver, and this demand is largely inelastic. Even in periods of economic slowdown, manufacturers are not pausing production. This insulates silver from some of the downside risks faced by other commodities. In addition, geopolitical uncertainty and safe haven demand continue to create upward pressure on prices. Every news headline highlighting conflict, sanctions, or economic instability tends to reinforce silver's role as a defensive asset. Technically, the silver market remains in a bullish consolidation. Short-term corrections are natural, and the current trading range reflects a healthy pause before the next leg up. If the market absorbs the forced selling from rebalancing events, we could see a continuation toward triple-digit silver. Long-term charts show that previous cup and handle formations and breakout patterns set the stage for sustained upward momentum, even when temporary dips occur. The gold-to-silver ratio also suggests that silver may continue to outperform gold, providing additional incentive for strategic accumulation at current levels. Monetary policy will continue to play a pivotal role in the silver market. Despite expectations for modest rate cuts, weakening economic data, combined with potential fiscal and monetary stimulus, points to a more aggressive easing cycle. This environment favors precious metals, as currency debasement and liquidity injections increase the purchasing power of real assets like gold and silver. Stackers who position themselves during these correction periods can benefit significantly over time, acquiring physical silver at prices that are still historically undervalued. Finally, market psychology is a factor that cannot be ignored. Fear-driven selling in paper markets often triggers temporary dips, but these are usually short-lived. Experienced stackers recognize that volatility is an opportunity, not a threat. Accumulating during these periods ensures that your long-term holdings grow in both size and value. Even as short-term traders react to headlines and charts, physical metal holders remain largely insulated from paper market swings, reinforcing the importance of a disciplined, long-term strategy. Silver is not just a speculative asset, it is a tangible store of value that benefits from economic uncertainty, industrial demand, and geopolitical instability. Any short-term volatility should be approached with a strategic mindset, focusing on long-term accumulation rather than trying to time the market perfectly. For those who understand this dynamic, current market conditions provide one of the most compelling entry points in recent years, making it a prime opportunity for smart stacking.